Hello, I'm Shaun Richards of Notayesmaneconomics, and today I'm going to look at the UK. We've had over the past 24 hours two of the main economic data series released. Yesterday we had the wages numbers, today we moved on to inflation, and there's quite a bit to think about in that. Firstly, let's start with this morning's good news, which is that the rate of inflation across all of the measures that we have has fallen back. A major influence on that has been transport costs. They went up in the August numbers, have dipped back again in September, so there's a bit of sort of noise in the numbers there. If we look at this internationally now and compare the UK to what we might consider to be our peers, the euro area number is 2.1%. We've had on the same comparison 2.4% this morning. And the US is in a broadly similar area, slightly different number, doesn't measure it quite the same way. So what that's telling us is that one factor which has been an influence in UK inflation, which is the pound and the way that it fell post the EU leave vote, has now drifted out the numbers pretty much. So our experience is mostly that of the rest of the world. What is that? Well, in general, this year has been driven in inflation terms by the oil price and its rise. This all depends on exactly which oil price you take. But for example, Brent crude oil is up about 40% over the last year. So we see inflation now is back to some extent around central bank targets or a bit higher. As it happens in the UK this time round, we got a little bit better number. Why is this good? Well, because these days, the main number we look at in terms of economics is real wages. Economists, because it's called the dismal science, love to look at numbers which have not been going so well. And the one in the credit crunch era that's been performing pretty much to that vein has been real wages. In the UK, this really matters on several counts. The first is that the establishment has gone to an enormous effort to twist the numbers to try and make them look better. Those of you who followed the wages numbers yesterday will have seen so many places across the media, including the BBC, saying that wages growth is 3.1%. Well, that is if you really narrow it down. They kind of missed an opportunity because the Bank of England likes to narrow it down even further and look at private sector regular pay. And so in the last couple of months, you could have said that that was 3.3%. So you could have nudged the number higher. But the point here is that that isn't actually representative of the overall position. If you look at total pay, that's growing at 2.7%. So a lower number, which of course is why that gets slipped to the background. If we now come forward to inflation today, we see that there's also a preferred measure of inflation. It's called CPIH, sorry for the alphabetic spaghetti, but that comes in at 2.2%. So if we compare preferred measure with preferred measure, places will tell you that real wages are now rising, approximately by 0.5%, although the numbers don't exactly coincide in terms of the months they cover. This has led places to put out saying that over the year we might see real wage growth of 1%. That relies a bit on wages picking up and inflation falling, which of course are maybes. The problem with that is I've already explained the issue with the wages number, but if we move to inflation, they've got themselves a preferred measure that goes at 2.2%, which is lower than all the others. How have they done this? This is driven by the use of what are called imputed rents. This is the way of judging how people that own their own houses see inflation. The problem with this is they're never actually paid. And it's quite a big player, mover and shaker, in that index because it's around 17% of it. According to them, rents are rising at an annual rate of around about 1% under-occupied housing costs. So already you're beginning to see the issue here. That's dragging the numbers down. Tells everyone they're better off. The problem with this is that these rents aren't paid. And don't misunderstand me, rent's perfectly valid for people that pay it, but not those that don't. So here we get a crucial dividing line on your view of the UK economy. If you take the official view, real wages are rising, albeit not by very much, but there's a marginal increase. If you go back to what, until recently, they were telling us was the inflation rate, things are about flat. If you go back to an older measure, the retail prices index, you see that real wages are still falling. So those of you viewing this I'll let you decide for yourselves what your own experience is, but across the range of measures, you get quite different answers. This tells us several things. One is my area of speciality, how you measure inflation. The other, if we look at a broad sweep of the credit crunch experience, is that real wages and the situation's very, very tight here. It matters a lot how you define things and try and measure it, which is another way of saying it's not been clear-cut growth. This is, according to all the economic theories of places like the Bank of England, something that should be there, but it isn't. If we move internationally now, there's a very, very similar picture. Those of you that follow Japan will note that there are regular claims that Japanese wages are about to break out, have broken out, are breaking out, did break out. You can pick whatever you like. The reality is a few months later, they all go silent as it appears, oh, no, it hasn't. And the general picture remains one that wages have fallen there. So this is an issue. This is something that revolves around the sort of experience of our times, because returning back to yesterday's numbers, we see that actually employment, as we measure it, whichever way you try and do it, comparing it to unemployment, hours worked, that sort of thing, been very strong. But what people are paid for it hasn't been. And this then brings us back to today, which is inflation and how we measure that. One quirk, if you like, of looking at this is if you project the way that the inflation numbers have changed, so RPI 3.3%, CPI 2.4% today, CPIH 2.2%. If you project that forwards in preferred measures, for the same situation now, inflation somewhere around 2050 will be measured as 0%. And that really is the problem of what they're trying to do. Thank you.